Hi, this is Roger Nussbaum. Welcome to the Big Picture for the week of January 7th, 2007. Two things on the docket today. One, the current state of the market and some of the trading this week, and then my reaction to a comment that was left on the blog Friday afternoon. First, the market. Someone can correct me if I'm wrong, but was it Mel Brooks in High Anxiety who went right into the camera like that and screamed, "Panic!" Well, it seems like parts of the market were panicking this week. Some of the commodity stuff, some of the emerging market stuff, and so on. In looking at how stuff did this week, looks like the EEM was down more than 5% or in that ballpark. GLD, which is a client holding, was down 4 points from 64 down to 60, so what is that, 7%, something like that. USO, which is that kind of Fakakta oil ETF, that was down $3 from 51 down to 48, so that was kind of a big percentage hit again, 6 or 7%. So kind of a rough week. Clearly, if you look at oil and you look at the various commodities and so forth, there was some sort of panic that occurred. Perhaps we can figure out why, perhaps we can figure out where it's going to go and so forth, but the bottom line is that the market had a severe reaction for whatever reason. These happen from time to time, and when they do, and they've happened quite a few times since I started the blog a little over a couple of years ago, people get freaked out and they sell. This creates panic. And I think we saw some measure of panic. It was not represented in most of the stock market averages. There was some pretty volatile whipsaw action maybe in the NASDAQ, but I wouldn't describe that as panic. So in these sorts of times where you've got segments of your portfolio that are dropping 5%, and let's face it, emerging markets are capable of dropping 5-10% in no time at all. This is kind of a mini stress test for you to determine whether or not you've got too much of, for this week's example, emerging markets or commodity exposure. I preach over and over again about moderation. All of these things make for good diversification, but there comes a point for everybody where they have too much. For some people it might be 2% is too much. For some people it might be 30% that's too much. And I get emails, fewer lately since that correction in the spring, but people who have 20 and 30% in emerging markets, that is an awful lot of volatility that you're taking into your portfolio, and that really is not the right thing for too many people. If you've got a quarter of your portfolio that dropped down 5%, that's a pretty big hit to take after 3 trading days in the year. Speaking of 3 trading days, there was a panic. You have, X amount in emerging, you have X amount in commodities and whatever. So you either did well this week or you didn't do so good. That's okay. It's how you handle a panic. Now, whether the panic is done in these couple of things or if there's more to come, at some point it ends, then it snaps back some measure, and then it'll trade a little more normally. I would expect, let's for the sake of discussion say the entire panic down works out to be 10% in these things. I might expect the snapback not to be 10%, but maybe a snapback is 6 or 7%, and then from there that last 3% gets made up slowly. That might be a reasonable expectation. Don't know if it'll be right, but often these types of panics correct themselves in that sort of a manner. Panic down X%, retrace some portion of X, and then trade back slower to take back the rest of X, so to speak. So again, if you really got freaked out this week, you learned you've got too much exposure in, whatever it is that's freaking you out. Take the chance when the market gives it to you to lighten up. Next thing, someone left an email. In one of my posts, I made a comment about, having a couple of low-octane stocks in a portfolio, like a food stock and a utility stock, kind of these high-yielding, low-beta stocks. Someone left a comment about Duke Energy dropping from what I think he said was 33 down to maybe 19. I'm not sure if those were his numbers, but those are pretty close. And he was thankful that he sold it because and rotated into something else. I forget what he rotated into, so he avoided that loss. Yeah, Duke went ex-dividend for a $13 payout of some sort. I don't know if it was a cash dividend. I don't know if it was some sort of the value of a spinoff. I don't know. I don't follow Duke Energy, but intuitively speaking, there was no way Duke dropped by a third or 40% or whatever that math works out to be. If it had dropped by that much somehow, it would have made news, and it was just ex-dividend. Here, you got to understand what you own. And now I'm not talking about being in touch with the news of what you own, which is one thing you have to do, but understanding what you own. Utility stocks don't drop by 40%. Big financials don't drop by 40%. That's not how it works in terms of a day or two magnitude. Enron and WorldCom maybe are the exceptions that prove the rule, but that's not how those stocks trade. I was kind of shocked by the thing. This person owns individual stocks and, swung and he missed, for lack of a better description, on what was going on with the stock. Hopefully you are in better touch with the individual stocks that you own in your portfolio, if you own any at all. And if you read this site, you know that I do believe in individual stocks as being a part of the mix, not just products. But that's enough soapboxing, and have a good weekend. Oh, one other thing. Someone is going to invariably leave a comment about my hair being messy. We had an accident out on Walker Road, and I responded with the fire department. My job was to stand in the cold and make sure traffic didn't go through, and I was wearing a knit hat. And so for the people that are dumb enough to care about my appearance, didn't comb my hair after I got back. Have a good weekend.